Well, what we say in the quarterly review is that there is indeed a certain amount of daylight that we can see between the state of financial markets, particularly risky asset prices and prospects ahead. Having said that, it's always very difficult to read financial markets. Where we see some signs of daylight is both in the equity markets. In general, valuations are on the high side from a historical perspective, but also in credit markets, and particularly in credit markets, where we see that spreads are again on the narrow end of the historical experience, while of course the credit quality has been deteriorating. How this will be resolved going forward it's very difficult to tell, because as we do underline in the quarterly review, very much will depend on the evolution of the virus and the pandemic.
Claudio, the final paragraph of the report certainly packed a punch, and in particular you point out the absence of the fall in interest rates. The long-term consequences of US and European stock prices would have been roughly 18% and 16% lower than they were on the 4th of September. That's extraordinary. So you're actually crunching the numbers and telling us that lower interest rates have inflated some stock prices.
Well, it's natural for low interest rates to raise asset prices. That's precisely the typical relationship that you see. Now, as regards the specific number that you quoted, I would take it with a spoonful of salt, because it's always very, very hard to make precise estimates about these relationships.
What we have witnessed on markets in the last week or so, some of the momentum coming out of those big tech names, and clearly there's been reports around the role of Softbank as the NASDAQ whale buying up call options. What do you make of the rout in tech stocks? Do you think we're done, and is this healthy to see?
Well, first of all, I don't have a crystal ball. If I did, I wouldn't be here. Clearly, the correction is not inconsistent with the daylight that we mentioned. And we also saw that there were a number of technical factors at play. For example, as you mentioned, large purchases of call options. But these call options are not just purchased by institutions like the one you mentioned, but also by retail investors, which is, again, typically a sign of frothiness in markets.
Is there something wrong then in the regulatory environment or market environment where one company, Softbank, engages upon buying billions of dollars worth of call options and distorts the markets and requires other market participants to get involved? Do you think there is something wrong in this environment we're now witnessing?
Well, I don't think that the environment per se is specific. Those types of operations we have seen many times before. The appropriate regulatory response is something that policymakers have always grappled with, particularly from the perspective of investor protection. And it's something that I'm sure will continue to be the case.